Hi everyone, welcome to my YouTube channel which is explore yourselves, banking and general knowledge etc. Today I am going to discuss about RBI's rules effective from 1st April 2026. The beginning of the financial year on 1st April 2026, the Reserve Bank of India introduces a comprehensive set of reforms designed to reshape the country's banking and financial ecosystem. These changes reflect a clear shift towards strengthening transparency, enhancing digital security, tightening risk management, and expanding financial inclusion across all sections of society. The new framework aims to make banking more responsive to real time developments, safer for digital users, and more accountable for institutions. By addressing key areas such as credit monitoring, deposit safety, lending discipline, and access to basic banking services, the reforms seek to build a more resilient and customer centric financial system. The new financial year begins on 1st April 2026. A sweeping transformation quietly reshapes the banking landscape under the direction of the Reserve Bank of India. The changes are not abrupt disruptions, but carefully structured reforms aimed at building a system that is more transparent, secure, disciplined, and inclusive. The most noticeable shift appears in the way credit behavior is tracked. Credit scores, once updated monthly, now reflect changes every week. This subtle yet powerful move ensures that repayments, defaults, and financial discipline are captured almost in real time. Borrowers gain quicker recognition for responsible behavior, while lenders benefit from sharper risk assessment, reducing uncertainty in lending decisions. At the grassroots level, banking becomes more accessible. Basic savings bank deposit accounts evolve into stronger financial tools. With no minimum balance requirements, free access to essential banking services, and full digital integration. These accounts begin to serve as a bridge between the unbanked populations and the formal financial system. The push toward financial inclusion gains real momentum. Meanwhile, behind the scenes, the stability of banks is reinforced. Liquidity norms tighten, especially for deposits originating from digital channels. Banks are required to maintain stronger buffers, ensuring they remain resilient even during sudden withdrawals or financial stress. Government securities continue to play a role, though with cautious valuation adjustments, reflecting a more risk-aware approach. The capital markets discipline replaces excess funding provided by banks to stockbrokers must now be fully secured. This eliminates speculative leverage and reduces systemic risk, signaling a shift toward a more controlled and stable financial ecosystem. Digital transactions, which have become the backbone of modern finance, are further secured. Two-factor authentication becomes mandatory across platforms, adding an extra seal against fraud. Each transaction now carries an added layer of verification, making digital payments safer for millions of users. Corporate banking relationships also undergo stricter scrutiny. For large exposures above a defined threshold, only banks with sufficient stake can maintain primary account control. Others are limited to collection roles. This ensures accountability and prevents fragmented oversight in high value lending. Non-banking financial companies find themselves declassified under new regulatory lenses. Certain entities, especially those without public funds or direct customer interactions, may receive regulatory relaxations. This nuanced approach allows innovations while maintaining oversight where it matters most. Connected lending. Loans given to related parties faces tighter boundaries. Renewals of non-compliant loans are no longer permitted, ensuring that governance standards are upheld and conflicts of interest are minimized. Depositors, often the silent backbone of the banking system, are given greater clarity. Banks must now openly disclose the insurance premium paid for deposit protection. This move enhances trust and awareness, reminding depositors of the safeguards in place. Risk management becomes more dynamic as deposit insurance premiums are linked to the risk profile of each bank. Stronger institutions benefit from lower costs, while weaker ones pay more, creating a natural incentive for prudent behavior. Digital banking expands further into everyday life. Even the most basic accounts gain full access to mobile and internet banking, pushing the economy closer to a seamless cashless environment. Finally, access to credit against gold becomes easier and more standardized. Borrowers, especially small ones, find relief in the simplified processes and uniform rules across institutions. Taken together, these changes form a cohesive vision. The system moves toward greater transparency through frequent data updates and disclosures, stronger risk control through tighter norms, enhanced digital safety via authentication, broader inclusion through accessible accounts, and improved credit discipline across institutions. The transformation is not just regulatory, it is structural. It redefines how trust, security, and opportunity coexist within the financial system, setting the stage for a more resilient and inclusive banking future in India. In conclusion, the reforms introduced by the Reserve Bank of India from April 2026 mark a significant step toward building a stronger and more future-ready banking system. By combining greater transparency, stricter risk controls, enhanced digital security, and wider financial access, the new framework ensures that both institutions and customers operate in a safer and more accountable environment. These measures not only reinforce trust in the financial system but also encourage responsible behavior among all stakeholders. As banking continues to evolve in a digital and interconnected world, such balanced and forward-looking regulations lay the foundations for sustainable growth, stability, and inclusive economic progress in India. Disclaimer: the information presented is a general interpretation of the reforms announced by the Reserve Bank of India effective from 1st April 2026, based on the RBI notification. It is intended solely for informational and educational purposes and should not be considered as official guidance, legal advice, or financial advice. For accurate details, clarifications, and applicability, readers are advised to refer to official circulars, notifications, and publications issued by the Reserve Bank of India or consult with qualified financial professionals. The applicability of these rules may vary depending on specific banking policies and individual circumstances. Thank you very much for your patience. Request for like, subscribe, and share.